Hi guys, in this video we will be discussing about accounting principles and conventions. First of all, we will be discussing what accounting principles are. Accounting principles are the body of doctrine commonly associated with the theory and procedure of accounting. They are rules or laws to guide the action. Accounting is basically classifying, summarizing, or even interpreting business transactions. So, accounting principles are guidelines or laws or rules in order to guide these actions of classifying, summarizing, and interpreting various business transactions. Next is conventions. Conventions are usage and customs to which the accountants have adopted to have universal acceptance. In order to bring some universality or uniformity to the accounting procedure, that is, if one accountant from a company goes off and they appoint a new one, the new one should also be able to understand what is written in the accounting books. So, in order to bring a universality so that everybody understands, all around the country at least, these accountants have adopted some customs or usages or methods which is applicable everywhere. Whoever new comes in will be able to understand. Moving on to the various conventions and principles, the first principle is revenue recognition. The concept deals with the point of time at which the revenue is earned. Revenue is earned when the title of goods passes from the buyer to the seller. No sale can be said to be taken place unless it is realized in money or money's worth, or at least some legal obligation to pay has been made by the buyer. Any sale has said to be taken place only when the title of the goods is passed from the seller to the buyer. For example, I want a pen. I went to the supermarket and I bought this pen. I gave him money. Then he gave me the pen. So there's a sale. So the sale of this pen takes place only when I pay him the value of the pen in terms of money. And he gives me the pen, and when he gives me the pen, he passes the title of the goods or the ownership of the pen to me, that is from the seller to the buyer. Now it is like this: either the payment can be done in cash then and there, or at least a legal obligation that this payment will be done in future should be made. Verifiable objective. It is also known as objective evidence concept. It means that entries in the accounting records and data recorded in the financial statement are capable of verification, supported by some objective evidence. Example: invoices or vouchers of sales or purchases or bank statements. Here, according to this concept, every transaction which is recorded in the books of accounts, or when the financial statement at the end of the year is audited, there should be supporting documents to support whatever is recorded in the books of accounts. That is, if there is a sales of rupees 100 in the books of accounts, then there should be a voucher or a statement by the bank or any supporting document to say that this transaction of rupees 100 is true. You can't just simply write any transaction or any purchase or any sale just like that. There should be some supporting document to claim that this transaction is true. And that is why it is also known as objective evidence. There should be an evidence proving that this transaction which is recorded is genuine and true. Reference: Accountancy 1 by P.K. Lazar.